Good morning, everybody. What a pleasure to see you here at the Wilson Center. My name is Duncan Wood. I'm the Vice President of Strategy and New Initiatives here at the Wilson Center. I am particularly delighted to be part of this event today, talking about the financial system of India, a report prepared by the IMF. The first thing that I ever published in my life was actually on IMF relations with South Africa during the transition period in 1992. And reading the report reminded me once again of the importance of Article 4 consultations and the fact that the IMF does so much more throughout the year rather than just that once a year check-in. So I was delighted to be invited by Michael Kugelman to introduce this event. And let me just say that here at the Wilson Center, we are an institution that is dedicated. Our mission actually says that we are dedicated to bridging the gap between the worlds of learning and public policy. My 2.5-year-old daughter this morning asked me what I did, and I said, well, I try to help people to understand what's happening out there in the world. And I think that that's a very simplistic way of saying it, but in fact, we are trying to do that on a daily basis. And by giving exposure to publications such as this, I think that that's a critical part of our mission. We're also fiercely nonpartisan. That's one of the most important things about the Wilson Center. Many think tanks say that they're nonpartisan or they're bipartisan. In fact, we have to be. It's in our mandate from the U.S. Congress. A work on the financial system globally, or in the case of one country, is vitally important to our work as well. We have recently created the WABA Institute for Strategic Competition. Its director, Mark Kennedy, will be with us today up on the stage. We focus, of course, on issues such as supply chains, on trade, and, of course, the evolution of cryptocurrencies and fintech, and, of course, their implications for financial stability and prosperity. India matters to us here at the Wilson Center. It's, of course, one of the fastest growing economies in the world. And last year, India passed the UK to become the world's 5th largest economy. And in purchasing power terms, it's already the world's 2nd largest economy. This year, India will pass China to become the world's most populous country. And 2023 is a big year geopolitically for India. It holds the presidency of the G20. And the meeting of the G20 is something that many people are looking forward to and hoping that we will see great advances in terms of international cooperation. India matters here in Washington. US-India relations have grown significantly over the last few decades, and there is a strong partnership that enjoys bipartisan backing in Washington, something which is more and more difficult to say these days. India has emerged as a key partner in South Asia for US efforts to counter China. And of course, as everybody here in this room knows, if there's one word that will mobilize people to come together, it is in fact China. A rapidly emerging area of partnership is on tech issues. The United States and India are looking to boost cooperation on critical and emerging technologies and semiconductors, among other areas. That's an issue as well on tech and semiconductors in particular that we've been spending a lot of time here at the Wilson Center thinking about. An indication of the importance of India's tech market and the growing interest of big tech is the fact that Apple opened its first retail store in India last week. And of course, an event that everybody will be focusing on later on this year is the fact that Indian PM Narendra Modi will likely come to Washington for a state visit in the summer. For these reasons and more, India is a major focus of our activities here at the Wilson Center. We have a deep legacy of programming on India, including a current project on US-India tech cooperation, a deep bench of talent here, driven in part by the contributions of our Wilson Center fellows, past and present, including our global fellows. They include Nirupama Rao, one of India's most distinguished diplomats who recently published a new book on India-China relations, and Suman Berry, one of India's foremost economists who now leads India's main government think tank. Our South Asia Institute, established last year, it still has that new institute smell about it, which is really wonderful, and directed by Michael Kugelman, is the institutional home for our many India activities. So this is all to say that we are delighted to be hosting today's discussion on India's financial system and how it can help strengthen growth. We're equally delighted to be partnering on this event with the IMF. We'll be releasing and discussing the IMF's new study, India's Financial System, Building the Foundation for Strong and Sustainable Growth. The financial sector in India has significant implications for everything from productivity and inclusion to climate change. It's also worth considering what role it can play in addressing India's persistent economic challenges like poverty and unemployment. We look forward to a discussion of this study with its co-editors and several commentators. And now I would like to introduce Dr. Antoinette Sayer, the IMF's Deputy Managing Director. Dr. Sayer assumed office as Deputy Managing Director in March of 2020. She has been a distinguished visiting fellow at the Center for Global Development since November 2016. Previously, was Minister of Finance in post-conflict Liberia between 2006 and 2008, during which she developed the country's first poverty reduction strategy. Before that, was at the World Bank for 17 years, including as country director for Benin, Niger, and Togo, and senior country economist for Pakistan and Afghanistan. I'm delighted now, and it's a great honor for me to invite Dr. Sayer to come to the stage for her opening remarks. Thank you so much.
He's much taller than me, so I have to lower the mic. A very good morning to everyone. Really a pleasure for me to join you, and thank you so much, Dr. Wood, for the introduction. Let me begin by thanking the Wilson Center, of course, for partnering with us at the IMF today and helping us launch this new book on India's financial sector. It's, we think, an important book on a sector that is critical to India's growth and development. And the book provides, as one would expect, of course, a comprehensive view of the sector, but it also offers an analysis of specific financial sector policies that can better support India's growth potential. So, as backdrop to the book, I will first comment briefly on India's remarkable economic and financial journey. In 1991, when India embarked on its economic liberalization, its real per capita income was just shy of $600. Today, that has more than tripled. An estimated 400 million people in India have been lifted out of poverty just in the last 15 years. And this is one of the fastest poverty reduction rates in the world. And India's role in the global arena has also shifted dramatically. In 1991, the country was one of the world's largest aid recipients. Today, India is a net donor. In purchasing power parity terms, it is also the third largest economy in the world, expected to contribute about 15% to global growth this year. And also this year, India, of course, is taking a lead role on the global stage with its G20 presidency. In that role, its agenda focuses on global public goods and strengthening international coordination around debt, crypto assets, climate, and digitalization. And India's economic progress over the past decades has been underpinned by a transformation in its financial sector. The 1990s saw an increasing role of private sector banks, the introduction of universal banking, adoption of international best practices in regulation and supervision, and the creation of the National Stock Exchange as well as electronic trading. Thanks to these developments, larger firms were able to increase their access to market-based funding using both bond and equity markets. For their part, households and small and medium enterprises could rely on banks and non-bank financial companies. But India's achievements in the financial sector clearly go beyond numbers of banks or market capitalization. The country has impressed the world in fostering financial inclusion through its public digital infrastructure. Just a decade ago, local shops were filled with people, of course, buying and selling goods with cash. Today, financial transactions are mostly executed with smartphones. And India's public digital infrastructure is also helping to improve the efficiency of public finance management. On the one hand, the unique identifier based on biometric measurements, which underpins the digital payment architecture, allowed the government to save money by eliminating ghost employees from its payroll. On the other hand, the digital payment system boosted revenue collection from the general sales tax while reducing tax compliance costs for businesses. It has also helped ramp up the distribution of social benefits to millions who were previously unreachable. And that proved particularly instrumental, of course, during the pandemic. The Indian authorities were able to transfer $37 billion in social benefits to people's bank accounts in 2020 and 2021, avoiding costly intermediaries and reducing leakages. But of course, India's financial development journey has not always been smooth. It has faced external turbulences, such as the Asian financial crisis, the global financial crisis, and of course, more recently, the devastating impact of the pandemic and the war in Ukraine. But the authorities have drawn lessons from these shocks and applied themselves to identifying and implementing policies to increase financial sector resilience. India has also confronted homegrown challenges. One notable example of that was the default of systemically important non-bank financial companies in 2018. Since that crisis, the Indian authorities have upgraded their regulation and supervision and introduced a regulatory framework for non-bank financial companies. And important progress has also been made in bank recapitalization, corporate debt restructuring, and oversight of financial market institutions, as well as in crisis management. But more work lies ahead for India. This includes continued efforts to strengthen regulations of non-bank financial corporations, promote improved governance, and reduce the public footprint in the banking sector. India's financial sector is also confronting challenges facing all countries, such as the spillovers from the tightening of global financial conditions, the need to adapt to technological change, or the impact of climate change. And I should also make two additional points on climate change and financial innovation. The first is that India is of course highly vulnerable to the effects of climate change. It would benefit from broadening and deepening its sustainable finance market to support its climate mitigation efforts. The second point is that financial innovations and rapid financial sector development bring many opportunities, such as improved access to financial services by vulnerable populations. But we all know that they also present challenges for regulation and supervision, which constantly need to be upgraded to support healthy development of the financial sector while avoiding the buildup of risk. And these are issues that the IMF discusses with the Indian authorities through our annual Article 4 consultations and through regular financial stability assessment exercises. But as you will discuss today, thematic analytic work such as the book we are launching here also play a role. And we hope that the findings of the book can contribute to policymakers' reflections as they move forward. We also hope that they will be helpful in the public debate as India charts its way forward to what we hope will be an even brighter future in the years ahead. So thank you very much. Very much looking forward to the feedback from this important discussion today. Thank you.
Well, thank you very much, Dr. Syed, for those really useful opening remarks, and thank you to Duncan as well. So I'm Michael Kugelman. I'm the South Asia Institute Director here at the Wilson Center, and it really is my pleasure to be hosting, in partnership with the IMF, today's event. So with that, I'd like to invite our speakers and our discussants up to take their places at the table. And while everyone is coming up and getting settled, I'll take that time to introduce our speakers this morning. We have with us at the table now 3 co-editors of the book that we'll be discussing. They will speak. First, we will be hearing from Dr. Nada Choueiri, who's been the mission chief for India at the IMF since September 2021. Before that, she was mission chief for Malaysia and Singapore. Her career at the IMF spans 23 years, during which she worked on a range of countries in emerging Europe, the Middle East, and Asia. We also have with us Alfred Shipke, who's director of the IMF Singapore Regional Training Institute for Asia and the Pacific.
Before that, he was Assistant Director and Mission Chief for India and Senior Resident Representative and Mission Chief for China, and he was also previously Division Chief in the IMF Asia and Pacific Department. We also have with us, as our third speaker, third co-editor of the study up here with us now, Jarkko Turunen, who's Deputy Division Chief in the South Asia 1 Division and Mission Chief to Nepal in the Asia and Pacific Department of the IMF. In addition to country work, his work covers cross-cutting financial sector issues in the Asia region, and earlier he was Deputy Mission Chief for India, among other things. Before we start, I just wanted to note that we will hear several presentations and sets of comments. We'll hear from several discussants, which I'll get to in a bit. After these remarks, we will have a Q&A that will take questions from those in person, but also those watching us online. If you're watching us online right now and you have a question, you will see a chat box just below the screen that you should be watching the webcast on. You can type your question there. It'll be seen by my colleagues who will send any questions my way, and they'll be read out during the Q&A. So first, to start, we will have some scene-setting comments from Dr. Chueri. So Nada, please, the floor is yours.
Thank you very much. Is that working?
Yeah, it should be on. It's on. Yep.
Is it on? Okay. And so I can advance here, or?
You could use the remote, or you could advance on the screen.
Okay. All right. So thanks very much, and thanks for people attending here in the room and online for your interest. Before I give my part of the presentation, I just want to say a couple of words. First, words of thanks to Alfred, whose idea to put this book together is what is bringing us here today. He had the great idea to collect together analysis and knowledge of the recent work of IMF staff in this book, which, as our Deputy Managing Director said, we hope will be useful to policymakers and people who want to learn more about India's financial system. The book was the product of the effort of many IMF staff across a range of departments, and also collaboration with people in academia, and has greatly benefited from extensive comments from the authorities, and these comments have improved and corrected many errors in the book. But of course, all remaining errors are ours, the author's errors. And also, I have to say the usual disclaimer that this book represents the views of the authors, but certainly not official views of the IMF, its executive board, or its member countries. So with that, the roadmap for our presentation today, as Michael said, I'm going to give a few words about the macro-financial setting in India today. Then I will hand over to Alfred, who will talk about the changing structure of India's financial system. And then Jarkko will cover the rest of the book, which talks about linkages and supporting reforms, before he concludes with some takeaways. So in terms of the setting, I won't repeat what Dr. Wood and our Deputy Managing Director said about why this book is important and why we are talking about India today. They've mentioned its importance as the third largest economy on purchasing power parity basis, its significant contribution to growth according to our projections that we have just released in April in the context of the World Economic Outlook. The fact that India is really now the most populous country according to UN population projections. And last but not least, the importance of India in the global economy from the point of view of geopolitics and its G20 presidency. And how did India get there? I will also not spend too much time on this slide because our Deputy Managing Director told the story of India's development over the past 3 decades at least. It has not been linear. It has faced a lot of shocks, which she mentioned, external shocks from the Asian financial crisis, the global financial crisis, and more recently COVID and the war of Russia and Ukraine. But throughout these, when you look at the past 3 decades, average growth was 6.6%, which was pretty good number. Through these shocks, there were also very important reforms, which are also mentioned in the book. So, this is how India got today to where it is. And where is India today from a macroeconomic picture? The picture on growth is very positive. We are projecting India to grow at 5.9% in the current fiscal year. The fiscal year in India runs from April 1st to March 31st. So in FY24, we are projecting 5.9% growth. We view that this growth will be mostly driven by investment. We have seen in the government's budget a very ambitious investment program being laid out for the year, and we are expecting that this will crowd in private investment as well. We are seeing green shoots of that in high-frequency indicators, in PMIs, in robust credit growth in the financial sector. It has averaged 15% in the last fiscal year that just ended last March. So we are expecting investment to be a major driver of growth. Now, from the supply side, we see that services are the main engine of growth in the economy, particularly finance, insurance, real estate, and business services. However, one point to make here is that this sector is not the major employer in the economy in India. Services employ about a third, or they capture about a third of total employment, and the fastest growing segment of services in IT and finance only captures 4% of total employment. And this share has really increased very slightly over the past decade. A decade ago, it was 3%. It is really agriculture that is the largest employer in the economy, but agriculture is not growing rapidly. So the main comment from this is that while growth numbers are good, they are not generating the jobs that we need for a country like India today. I will say a couple of more words about the macroeconomy from the point of view of macroeconomic stability. When we look at internal stability, we focus on inflation and on fiscal developments. And here India has faced challenges. Inflation is relatively high. It has averaged 6.7% in the last fiscal year. And it has been driven by high commodity prices, but also by persistent high core inflation. And it has breached the RBI's tolerance band, which is 2 to 6%, throughout most of the last fiscal year. However, the good news is that both headline and core inflation have declined to 5.7% in March, and we see indications of a continued decline, so well within the tolerance band of the RBI for this fiscal year. On the fiscal side, the challenge has been large fiscal deficits by both central and state governments. Although they have been slightly declining before COVID, but with COVID came a huge shock that necessitated an increase in government spending and hence a ballooning of the deficit in India as elsewhere in the world. Post-COVID, if we can say post-COVID, there has been a return to sort of a deficit reduction path, but very small. So for the current fiscal year, the government is planning to have 0.5 percentage point of GDP adjustment on its central government budget. So on the domestic front, there are some challenges. On the external front, however, the position is looking much better. So India is enjoying external stability in the sense that current account deficits are very manageable. And in fact, the current account deficit has improved. We are estimating 2.6% deficit for the fiscal year that just ended in March. And we see it declining further in this fiscal year. And this is driven by booming exports, particularly in the services sector. The other counterpart also of the strong external position is foreign exchange reserves, which have increased over recent months. And today they stand, in mid-April they were at $590 billion, which finances 7 months of import. And we have assessment tools that look at the reserves holistically, and in our view, reserves are above 150% of the level that is adequate for a country like India. So a pretty strong position. So a final word on the overall conditions of the financial sector before I turn it over to Alfred. The financial sector is sound today, and its health has significantly improved. We see that banks are adequately capitalized. Capital ratios are higher in the banking sectors, in the private than in the public banking sector. And we see that gross non-performing assets as a share of total assets have declined, both in banking sector and non-bank financial companies. So today, the health of the financial sector appears in a good position to sustain investment and growth in the economy going forward. With those words, I now turn it over to Alfred.
Thank you. Thank you. Could you leave me with the...
Yeah.
So I want to pick up where Nada left off and focus a little bit on the changing structure of India's financial system. As a matter of fact, as Nada was saying, India's growth prospects are very strong. Given the country's current per capita income, even though it has increased a lot, there's still a lot of room for catch-up. So that's good news. On the other hand, India has a very young population, so that's another positive. The key, though, is for the financial sector to channel the resources to the most productive parts of the economy and to generate jobs, as Nada was indicating. Now, when it comes to the financial sector, it can impact India's economy both in the short term and in the long run. In the short term, when we have shocks to the real economy, they can be amplified by the financial sector and made worse. And so for the stability of the financial sector is very important. But the other one, depending on the health of the banking sector, bank lending can be constrained, and that ultimately undermines economic growth. So where are we today? So we've talked a lot about the reforms, and India has had significant reforms over the last 3 decades. But the banking sector, in particular public sector banks, still dominate the system. So 60% of total bank assets are held by public sector banks. Now, the remaining part of the system, of course, we have domestic private banks, we have foreign banks, and reflecting India's regional diversity, there are also a large number of rural banks and cooperatives. Now, one thing that matters, of course, for us economists is given that the banking sector plays such an important role, does the credit flow to the most productive part of the economy and firms? And so here we're looking at the link between credit growth, firm productivity, and the type of bank ownership. So whether banks are public or private. And the results suggest that the link between credit growth and productivity is weaker for firms that have strong linkages to public sector banks. Now, what does that imply? It means that that credit is not available for more productive firms. So the question is a little bit, what should be done? Now, in our view, there is significant room to reduce the footprint of public sector banks, meaning privatizations. The government itself has announced that it intends to privatize 2 banks going forward. But privatization is only part of it. The other one is to improve the governance of public sector banks, and especially make boards independent. Now, despite the fact that the banking sector continues to play an important role, the structure of India's financial system has changed quite a bit. In particular, there has been a sharp rise in what some people call non-financial, the non-bank financial sector, or in India we call it the non-banking financial companies. How did it happen? The banking sector grew rapidly until 2015, and there was some concern, and therefore the RBI undertook a bank asset quality review and also tightened bank regulation. Now, as a result of that, bank credit growth slowed down significantly, and this is a good example of regulatory arbitrage. So we had basically non-bank financial companies fill in the gap and provide lending, and they mushroomed. Now, while there was some regulatory arbitrage, there have also been some positive aspects, and that is that the NBFCs were providing credit to underserved sectors of the economy, especially the micro, small, and medium enterprises. Now, with the rapid rise of these institutions, as you can imagine, there are risks mounting, and that's what happened. We had the cases of two systemically important NBFCs default. And this is an example of the negative feedback loop that can be generated by the financial system, where we had difficulties in a few systemically important non-bank financial companies that spilled over into the broader sector of NBFCs. And because of linkages to the banking sector, because the banks were lending to these NBFCs, it spilled into the banking sector. Now, as a result of that, the banking sector credit slowed down significantly, which then increased borrowing costs for corporates. Corporates started to default. The bank balance sheet got hit again, and you can imagine that slowed down economic activity. So faced with that, the authorities then tightened regulation, rightly so, strengthened capital requirements, provisioning requirements, especially for systemically important NBFCs. As a matter of fact, for the larger institution, there has been some regulatory convergence. Now, having said that, are there areas where there could be further improvement? One of the recommendations would be that the funding sources of the NBFCs, they don't rely so much on deposits, are diversified. That reduces risks. And the other one is to maybe reduce the dependence on bank loans so that the spillovers to the banking sector could be minimized. Now, the other part of the financial system that has changed rapidly is what we call market-based financing or capital markets. So India now has an equity market that is the 5th largest in the world. But as we have seen, there's also quite a bit of fluctuations. More recently, we saw that. When it comes to the bond market, the corporate bond market is about a little bit less than 20% of GDP today, and that still has a lot of room to grow. And what are the benefits of having a well-functioning corporate bond markets? It would foster competition in the financial system, competing with banks and non-bank financial companies, which would in turn allow companies to receive long-term financing, and it could also facilitate innovation. So the corporate bond market can play a critical role. Now, when it comes to the sovereign bond market, if India were to be included in global bond indices, that of course would lead to significant inflow, passive inflow of capital. Now, what are the reform areas in capital markets? We're of the view that there can be a lot done to broaden the investor base. Currently, it's the financial sector that is providing a lot of the financing. It could be broadened. And other areas, strengthening creditor rights and bond market liquidity. Now, as was mentioned earlier, if we were to discuss whether India's financial system had developed or not, and we would look only at traditional measures, credit to GDP growth, equity market capitalization, outstanding issues of bonds, we would actually not do India justice, because a lot of the innovation, especially as it relates to fintech and financial sector inclusion, has come from the digital side. And I think it is fair to say that leveraging digitalization for financial inclusion, India has been nothing else but short of spectacular. Only in 2011, not that long ago, only 35% of the population, remember India is a large country, had access to bank accounts. As you can see from this figure on the left-hand side, you see the population, billion number of people, and you can see how much improvement has been made. And it is the result of a multi-pronged approach. Some people call it the India stack, which is a combination of first introducing a biometric digital identification system. Again, this was only in 2010, not that long ago. Then rolling out schemes that would facilitate the issue of debit cards that are linked to these identification systems, and a united payment interface. And a critical part here is the collaboration of the public with the private sector. Now, other countries have done that too, but what really sets India apart is the scale and the low unit cost of operating these systems. So that allows even small retail stores to participate in this exercise. Now, as we said earlier, there is no time to rest on your laurels, because especially economic disadvantaged and those in rural areas, many of those still don't have access to financial services. The challenge here is that the obstacle has nothing to do with technology so much. It is actually something very simple, but not that easily overcome, which has to do with financial and digital literacy. Now, India, as other countries in the world, are faced with climate challenges. The shocks that can come from climate can have large economic and social costs. But they can also undermine financial sector stability. Now, India's government has committed to reducing carbon intensity and to achieve carbon neutrality by 2070. But here, the financial sector can also play a critical role in channeling the resources to the sustainable sectors. And an important part is what we call the ESG market. Think of it as the green bond and green equity market, where India has made significant progress. It's still a small share of the bond market and assets under management, but it has gone up significant. And this year, the government demonstrated that it wanted to make further progress by issuing the first sovereign green bonds that have been extremely well received. And the yield on those bonds were actually lower than that for regular government bonds. We call it a greenium. Now, what else can be done? Again, as in other places, investors want to have information about risks, so data, better real-time data about the risks in the financial sector will allow investors to make a decision how to invest their resources. With that, I'll pass the baton to my colleague Jarko, who will talk about linkages and supporting reforms.
Thank you. So Alfred spoke about the many changes in the financial system that we have seen so far in India. And those changes, of course, have links to the rest of the economy and also have benefited from a number of supporting reforms. So this final section of the presentation highlights chapters in the book, 4 areas that of interlinkages and key supporting reforms. capital flows, corporate sector vulnerabilities, debt resolution frameworks, and monetary policy communication. So let me start with capital flows. India, of course, continues to benefit from significant capital inflows. This reflects the favorable growth prospects and also longer-term prospects such as demographic trends that we spoke about earlier, but also the still relatively low per capita income and large development needs. Based on our external sector assessment that we do as part of the Article 4 every year, we assess that current account deficits of about 2.5% of GDP are financeable by capital inflows in the current structure. India has, of course, been gradually liberalizing its capital account. The initial focus has been on foreign direct investment and on equity flows, both of which have been historically less volatile in India than in regional peers, and that is shown on the chart here. The authorities' plans to further liberalize the FDI regime in particular are important for attracting stable capital inflows looking forward. Foreign inflows into debt markets in comparison remain relatively low compared to peers. However, again, here's a progress. There's progress on the authority side in terms of gradually easing restrictions on debt flows, which are increasing inflows. And as Alfred already mentioned, the prospect of India's inclusion in the bond indices could result in large passive inflows. As we know, though, capital flows are beneficial, but they also can carry risks, given that in particular portfolio flows tend to be more volatile and can be subject to changes in global risk appetite. India has experienced several episodes of strong inflows that have been followed by reversals. These include, of course, the 2008 global financial crisis, the 2013 taper tantrum, as well as the COVID shock period. The analysis in Chapter 8 of the book suggests that indeed capital flow cycles in India have become shorter and have been associated with greater capital flow volatility. Policies can, of course, contain volatility, and here strengthening policy frameworks such as the medium-term fiscal framework and clear communication about policies can be helpful. Second, addressing when we look at the resilience of the financial system, it's useful to think about shocks emanating from the corporate sector. And this is the topic of Chapter 9. In terms of developments following the global financial crisis and before the COVID, India's corporate sector had been deleveraging. This has been reflected in improvements in profitability. In particular, medium return on assets improved from 0.9% in 2009 to 2.2% in 2019. The interest coverage ratio increased to 2.8, almost reaching levels seen before the global financial crisis. Small firms didn't do as well. Their profitability has been persistently low throughout the period. Stress testing the corporate sector can be helpful in terms of identifying risks and also in terms of evaluating the impact of policies, and this is what is done in the chapter. The exercise uses the COVID shock to run a series of stress tests on the baseline outlook and a number of adverse scenarios. Three sets of results to highlight. First, the stress tests show that without support to the banking sector, in the most extreme scenario, the capital adequacy ratio of banks would have declined from about 15% to about 8.5%. And this is, of course, below the regulatory requirement. The exercise, however, also looks at the impact of policy measures, in particular borrower relief measures and monetary policy, with the impact shown here in this chart for different scenarios, and finds that those measures were effective in mitigating the shock. And as a result, on average, policies would have avoided a fall below the regulatory minimum, even in the most extreme scenario. However, as you can see in this chart, Not all banks do as well. In particular, the public sector banks in the extreme scenario would not have met the regulatory minimum, even with policy support. The third area of key supporting reforms is analyzed in Chapter 10 and relates to private debt resolution frameworks. Effective resolution frameworks for both corporates and households are, of course, very important in terms of how the financial system can effectively allocate resources to allocate, in particular, allocate savings to investments. Think of zombie firms. Left unaddressed, they undermine the reallocation of resources to productive firms. Now, resolution frameworks usually include procedures for debt enforcement, restructuring, and liquidation. And here, the introduction of the Insolvency and Bankruptcy Code, the IPC, in 2016 is a key milestone for India in terms of reforming the debt resolution framework. Prior to the IPC, debt recovery in India was very time-consuming. It was expensive. It was uncertain and prone to abuse. This in turn hindered bank lending. Also, prior to the IPC, in the case of default, there was a tendency to evergreen loans or to enforce collateral without actually assessing the viability of the business. As I said, the IPC has been a key milestone in terms of policy reform. The major components of the IPC are consistent with international best practice and have led to an establishment of an insolvency regulator, as well as professional agencies and specialized courts. There's nevertheless room to improve the framework further, and some legislative work is ongoing. There are three key areas for improvement that are highlighted in Chapter 10, and they include, first, encouraging out-of-court processes. Second, for in-court restructurings, the current timelines are ambitious and need additional resources and adjustment to be successfully achieved. And finally, staffing and capacity development needs exist, including the need to increase the number of judges, provide training for judges and other court officials, and filling existing vacancies. The fourth area that I will speak about is monetary policy communication, and here institutional reforms that reduce market volatility can make financial markets more attractive for savers and investors, and here monetary policy communication is an important component of that. As you probably know, RBI, the Reserve Bank of India, introduced its flexible inflation targeting framework in 2016. There's evidence that this framework has been associated with improved anchoring of inflation expectations and also better predictability of monetary policy decisions. Chapter 11 reviews recent communication of RBI and finds that forward guidance on the monetary policy stance during the COVID period has helped moderate uncertainty and has supported some asset prices. The chart here illustrates the intraday impact of forward guidance. In particular, an event where the RBI introduced time-based forward guidance that said that they will maintain an accommodative policy stance at least during the current fiscal year and into the next financial year. As you see from the chart, the government bond yields fell with the announcement. The chapter also presents regression analysis that shows, in line with evidence for other emerging markets, that the relationship between monetary policy surprises and yields for government and corporate securities is positive and statistically significant. Going forward, there is room to further refine the communication tools, in particular by improving the forward-looking communication about India's economic outlook and about the RBI's reaction function. Let me conclude here with two slides on the main takeaways. First, India's global economic role is increasing. India appears to be recovering well from the pandemic and appears to be settling into a period of macroeconomic stability. with some risks. The long-term outlook is positive. For example, it still can benefit from a positive demographic dividend. More can be done, and investment in particular can boost long-run growth potential. And here, the role of the financial sector, of course, is critical in terms of allocating resources efficiently. The book illustrates many ways in which the system has changed. As Alfred mentioned, public banks still dominate, but NBFCs, the growing capital markets, digital finance, and the development of ESG markets are bringing important changes to the system. And this is the final slide. We have highlighted 4 key reform areas shown here on the left-hand side. Reducing the share of public banks and strengthening their governance is first. Second, NBFCs are playing an important role, but there's need to diversify their funding sources and also reduce linkages with banks. Third, corporate bond and ESG markets can develop further. And fourth, finally, digitalization to foster financial inclusion has resulted in significant gains, of course, but as Alfred mentioned, improving digital and financial literacy remains critical for those gains to be increased. 3 supporting reforms: continued gradual capital account liberalization. Second, further improving private debt resolution frameworks. And third, continued institutional reforms that reduce market volatility. Let me stop here. We of course have the book excerpt available online in our library website through the QR code, both in English and in a number of other languages as well. So let me stop there. Thank you.
Well, thank you very much, Jarkko. Thank you to Alfred, and thank you to Nada for that really wonderful overview of the study. And indeed, there are copies of the study, hard copies of the study, right outside as well. So please grab one on your way out if you didn't get one on the way in. I'm sure that the presentation has sparked some questions, and we're going to get to the discussion component of this event. So we're going to transition now, first of all, to hearing from our 2 discussants, our 2 commentators. And our first discussant, as you can perhaps guess because he's not sitting up here right now, is Viral Acharya. Dr. Viral Acharya, he'll be coming up in just a moment. He is a CV Star Professor of Economics at New York University's Stern School of Business. He was a Deputy Governor at the Reserve Bank of India from 2017 to 2019, where he was in charge of monetary policy, financial markets, financial stability, and research. And then our second discussant, seated next to me, is my colleague, the Wilson Center's own Mark Kennedy. Mark is director of the center's WABA Institute for Strategic Competition. His previous experience includes serving as president of the University of Colorado and University of North Dakota. He's been a professor at Johns Hopkins University and also a member of Congress representing a district in Minnesota. And I should also say as well, I meant to note this earlier, I wanted to thank our 3 internal co-sponsors of this event today. One of them is the WABA Institute for Strategic Competition, as well as our Environmental Change and Security Program, as well as our Tech and Innovation Program here at the Wilson Center. So, Dr. Viral, are you here? We don't see you on the screen. Can you hear us? If not, while we're waiting on that.
Hi. Can you hear me or no?
Yes, we can hear you loud and clear. We can't see you, but we can hear you.
Yeah, so I think
It's
they
more
have
important.
to do something to put me on the screen. I'm not sure. I can just appear.
Yeah, that's
with
fine.
the magic.
And we don't need to, I think it's more important that we hear you than we see you, though ideally we'll see you
Okay.
too. Why don't you go ahead and offer some comments, and then we'll move
Okay.
on to Mark.
Very good. So sorry I can't be there. This is because we have an important discussion at some promotion and tenure meeting of the school, and it's probably the most important thing we do for the university. So I had to stay put here. Firstly, I want to congratulate Alfred, Yarko, Nada, and Marie for a really important and timely book. I think India is rightfully in attention everywhere globally. It has many things going right and is a very worthy contender of China plus one or the China plus N pivot, as it might be, of the global economy. I've discussed the book with Alfred at earlier stages as well. So rather than summarize the book, I thought I'll give a little bit of a context on why it's important to think about issues that the book is raising. India had a difficult pandemic in many ways. It's somewhat ignored at times that relative to the pre-pandemic trend, India is actually still below the GDP that it would have had at that trend. And so clearly there has been a catch-up, and I think the growth numbers that are being projected in VO and elsewhere are very heartening. It has to be kept in mind that this is an economy that actually lost out in a significant way at the pandemic, which only sort of underscores the importance of allocating capital right going forward, so that whatever efficiencies can be eked out in order to close that gap can be fully realized. Now, having said that, I think in the introductory remarks, I think Nada alluded to the issues of a fiscal deficit and inflation. And to me, these are really sort of sound macroeconomic balance issues that India needs to try and get right. It's been some time, I would say now, probably close to 7 to 8 years, that we have kind of let them slip on the fiscal front. On inflation front, clearly maybe the pandemic shock justified letting things slip a bit. But there has to be a plan to bring them back. From a democratic institution standpoint, personally, I also respect the legal mandates of a country quite significantly. There's the Fiscal Responsibility and Budget Management Act. There's the Monetary Policy Committee Act as an addendum to the Reserve Bank of India Act. These very clearly lay out what the targets are. And I think the government and the Monetary Policy Committee, I think, need to make some short-term growth sacrifices in a time when the long-term prospects for the country are very good to secure the long-term macroeconomic balance, in my view. Now, coming to the financial sector, one thing that can't be stressed more is how far India has come over the last decade. About 10 years prior from now, Indian banks were in a big mess. There was a house of debt that fell apart, especially bad loans to infrastructure and traditional industries. And it's taken a massive amount of effort to clean that up. It has cost some central bankers a lot of sleepless nights, in some cases, early departures, and so on. But nevertheless, the process has worked in terms of the cleanup of the banks, bringing down of the non-performing assets, and recapitalization of the banks. What this means is that if the growth impulses are there, at least the banking system, and to an extent the non-banking system as well, are in a position to allocate capital more efficiently than the distorted incentives that they had to evergreen and do zombie lending about 10 years back. So I think that's a very big plus as far as India is concerned. The book stresses that the public sector banks have gradually given up share to private banks. This is certainly true as far as deposit growth is concerned. It's certainly true as far as household credit is concerned. In corporate credit, though, private banks are not yet as big players, and that remains to be seen whether that changes with the new investment cycle that's taking hold. There's also an important issue there which I'm studying and I want to flag, which is that while public sector banks have reduced their deposit taking in India, they have significantly increased their asset management business. So, you walk into a branch of a public sector bank, they are mostly interested in directing you to their mutual fund rather than to their deposit account. I am yet to form a very clear opinion on whether this is good or bad, but it does worry me. Historically, India did have something called the Unit Trust of India, which was UTI, which was like a publicly funded mutual fund, which went belly up at some point. And I worry that many public sector banks are increasingly growing more on their asset management business. And I don't see why the largest asset manager should be a bank in the first place. But it seems that asset management business in India is now essentially being taken over by the banks rather than it being equivalents of Vanguards or BlackRocks. And have some discomfort about that growing concentration of banks in the asset management business. Something to think about. Third, I think the book makes an excellent point that insolvency and bankruptcy code is crucial to work more on. The cleanup of the banking sector, even if imperfect and not as fast as one might have liked, did happen on the back of insolvency and bankruptcy code. However, the execution times for cases there are slowing down. They are taking almost twice the required time they were supposed to take under the IBC Act. So the government needs to, I think, do something to get that back on track. I'm also a bit concerned whether India's largest conglomerates, which are growing larger and larger, as I've documented in my recent Brookings report, whether one of their bankruptcies, either of a subsidiary or of the bank holding company, can be handled well by the IBC or not. I think in that sense, maybe a true test of IBC hasn't yet happened. There are a few conglomerates which look heavily indebted and are in a deleveraging cycle right now, given that dollar funding has become tight. One way out could be to ask these conglomerates, almost treat them like systemically important financial institutions and get them to produce living wills, get them to document what their complex organograms are. How would you ring fence certain parts and modularly deal in a bankruptcy? Something like that could also be considered. But coming to the IBC, the bigger elephant in the room is when will India's corporate bond markets develop to be bigger and better? And my sense is this is where the importance of fiscal deficit controls and bringing down the public sector borrowing requirement comes in. Unless that comes down, India's savings just don't have any other place to go because there's just such a huge chunk being eaten up by borrowing at the central and state governments and their respective public sector enterprises. Just a final point, there is a growing view, which I don't 100% subscribe to, that essentially India is doing too much on financialization of its economy and doing too little on the real economy side. Of course, there's never a shortage of structural reforms to undertake. So at some level, that statement has got to be true. But I think there's a sense that India is just financializing without necessarily actually bringing about true real sector reforms. Of course, a big exception to that, as was stressed in the presentation, is India's digital India infrastructure, India stack, and the entrepreneurship in the services economy that's growing on the back of that. But to just take that criticism a bit seriously, my sense is that the resistance to fiscal deficit being reined in, the resistance to inflation being brought back to target levels, is because there's a constant financial desire to support growth through these expansionary debt and expansionary measures, monetary easing measures. I wonder if doing a little bit on the real side could relax the pressure on fiscal deficit and inflation. What do I have in mind? I document in the Brookings report that perhaps industrial concentration is contributing to higher markups in India. So something could be done that by reducing tariffs, increasing external competition, and not allowing concentration to grow so much that new firms can't enter in the sectors, as seems to be in data where the presence of the big conglomerates is becoming very large. That's one. And second is that India's human capital, which was also mentioned in the presentation, is not prepared to really join forces with the formal sector and the tech and non-services, tech and non-tech services export sector, which is growing very, very fast. A lot of it is stuck in agriculture. Tariffs in agriculture are very high. All input factors to agriculture are very, very heavily subsidized. So a fundamental rethinking is needed on where should the youth of India that are coming into the working age group, are they prepared to actually partake of growth which is happening in the formal and the tech and non-tech services exports part of the economy. I think this requires a refocusing on the human capital of the economy. It requires educating the children better. It requires vocational skilling for the youth, and it requires increasing the female labor participation rate, which has really collapsed after the pandemic, and surprisingly, especially in urban areas where they tend to be actually of the higher productivity type. So India's Phillips curve is steepening or getting raised. It needs to be flattened, and this would actually enable the financial aspects of the economy to become more in balance. Fiscal deficits can come down, inflation can come down. Those sacrifices won't look sacrifices if the real sector reforms counterbalance bringing in macroeconomic balance. Let me stop there. But once again, I just want to congratulate the authors. I think this is going to be a very, very timely volume, given where India is. And I know some of the chapter writers are in the audience as well, and I want to congratulate them as well.
Well, thank you very much, Dr. Viral, for those comments. I really appreciate that. And I should say that we were able to, here in the audience, here at the, in person, we were able to hear and see you. So thank you for that. Just a reminder for those of you watching online, if you have a question you'd like to pose to the panel, you should see a chat box as you're watching your webcast. Just post the question and it will be conveyed to us. Turn now to Mark Kennedy.
Well, thank you, Michael. It's great to be here, and it's a tough act to follow after this wonderful presentation and an excellent critique, but I'll try to add some unique insights. Let me first of all say it's a great report that I think will make an important contribution, not just to India, but certainly to the broader understanding of this important country. And if I sound like I'm critiquing India at all, please just view that as encouragement, because not just the U.S., but the world has a lot riding on India. U.S. is right now, as was already mentioned, in a bit of a China-U.S. tussle over the economy, over technology. And in that regard, we're looking for India to diversify our sources, as you already heard mentioned with Apple. So we want India to succeed. But the world needs India to succeed. The IMF recently released a report that said that India would be the second largest contributor to global growth, just nudging out U.S. by a little bit. But when you think about the challenges that we face with climate, with poverty, we're not going to be able to address those challenges unless the global economy is growing even faster, and that's going to really look to India to do more. But I would suggest India needs India to succeed, because India is riding a huge demographic wave. If you really look back over the last decade, something that we maybe didn't fully realize is China was driving a demographic wave, which was a big part of their extraordinary success over the last several decades. And now they're facing demographic headwinds. But if you look at the demographics of India, there is still going to be a propulsion of the growing workforce driving India's economy for many years to come. And that's where there's really no better demographic engine in the world to drive global economic growth than India. But the real question for India needs to be, is India riding that wave, or are the government policies driving that wave? And when we hear reports that we're still not gaining enough employment, that suggests that perhaps there might be a bit of riding it instead of driving it. So I see part of what I see this report trying to direct is, how can we adjust the dials so that the government policy is driving more economic growth, not just relying on what would naturally come from the demographics underlying it. And the path to do that is fairly clear. I mean, if you look at what, besides demographics, what drove China's enormous success was President Deng opening up to the market and not caring what color the cat was. And also, if you look at this report and you look at India's history, it's India's opening up to market reforms with a little prodding from the IMF that have really driven its growth, whether you talk about that tripling of its GDP per capita or the 400 million people coming out of poverty. So what we need to do is we need to figure out, and a large part of the discussions today have been directed towards, how do we channel resources more efficiently to those that are innovating, to those that are productive, and what is the ways to do that? Let me just mention 3 or 4 of the things that have already been discussed. The insolvency and bankruptcy reform, I think, was a wonderful step forward and played huge dividends. So the recommendations to make sure that we're staffed right and that we're doing things more efficiently and that we're doing perhaps them out of court, which is more efficient, is another path to really allow innovation to more flourish in the nation. We're in a tech-driven economy. Tech is moving fast, and India and any other nation isn't going to catch up unless they're tapping into that innovation. I, over my years, have had wonderful Indian students. I know how innovative they are. It's just a matter of whether the overall architecture of the economy can allow them to flourish. So I would put my emphasis on getting that continue to focus. But then we've talked about the degree to which government banks are still 60% of the deposits, are still a very, you might call it a heavy weight on the innovation, because as was pointed out, particularly with government banks lending, you don't see that direct link between more lending and more productivity growth. Why is that? We always think, I've been in both government, business, and in academia, and I can tell you, government does things more politically as opposed to what's the most efficient, what's the most innovative. So trying to lighten that heavy hand of politically directed government lending on the economy is going, I think, to help bolster the innovation and productivity. But what was on just a very recent slide that Jarko showed was that the capital requirements, capital held by public banks is less than private banks, is less than foreign banks. And you also pointed out that the only place where when we have a severe economic downturn that there's showing where you have insufficient capital is the public banks. Well, if we're not wanting to encourage them and we're trying to encourage the private industry, why would you let the public banks have less capital standards and have, as you show in a severe case, insufficient capital standards? So I would point to say, let's have a greater demand on having more of an equality, because when you let the public banks have less capital, they have an unfair competitive advantage vis-a-vis the private banks. And that's something that I think should be played out. It's not just that the banks are concentrated. It was already mentioned by our previous discussant that there's a heavy concentration throughout much of the economy in India, and perhaps the public banks are helping to facilitate that. If you look at the brethren nearby, Japan had its saibatsus and Korea had its chaebols, but they were both in tradable part of the economy. So that when they opened up their tradable part of the economy, it was those competition from outside forces that forced that rigidity to be removed and to unleash more innovation. So it's really, how do we do the same when most of the concentration are more in the domestic side of the economy, making it more challenging. And that's where I see the corporate bond market being so important, because opening up that corporate bond market and making it more significant will create competition, will create alternative sources. And as I read through the report, I got, the idea that it's largely the big players taking advantage of it, the existing corporate bond market, that many of them are financial players, and that they're more shorter maturities, tells me that that's really got even perhaps further to go than not. But when you think about what it takes to have a more robust market. We talked about a greater creditor rights. I recognize that that may be require some political courage to get done, but there's a huge payback for doing that. Better rating agency capabilities. Again, those aren't that expensive or that hard to do. And the insufficient pool of investors. But there's also talked about in the report the potential windfall if you got into the bond index, global bond index, to China. So I think there's a play to be made to have a concentrated, cohesive strategy by the government to deliberately try to make that bond market more attractive to those indexes. And that's perhaps just a matter of time that could really unleash that. And it wouldn't just be you'd have a stronger corporate bond market. I think that would have ways of spurring more innovation. We also just briefly mentioned at the beginning of the report was they need to make investments in infrastructure, education and talent's been talked about a lot, safety net or climate. All of those take money. And if you look at the deficit of the government, it's already pretty high. If you look at the debt, it's already pretty high. So I turn to that digital unleashing with a little different angle. Certainly it helped with financial inclusiveness, and certainly that's something that India should be proud of and that others should emulate. But you also mentioned that it helped increase revenue, because you're not going to get your financial house in order to be able to have a government financing revenue to tackle all these issues with greater, unless you address the fact that 90% of the economy is still an informal economy. And until you get that more formalized, going through digital channels where you can improve the revenues, I see a revenue benefit to the government that can be invested in some of these things, as well as when you have more formalized digitally, that can also help reduce the corruption, which is also a deterrent to further growth. So taking the effort for the digital, for the literacy, digital and financial literacy, and taking the effort, there's also cell phone penetration within the country could be greatly improved to help achieve this, are other areas where I would look at. And then I'll finally say what that will also help spur not just the digital financial side, but I think the broader economy, put less weight on the agriculture economy to be providing jobs, and that disproportionate weight looking to the agricultural economy to do jobs. I would suggest as part of the reason why we've seen India perhaps being more protectionist than we'd like them to be, protecting that agricultural. So these are some further steps that, again, are encouraging. We love India. They're doing great things. You're doing great things. We just want to help you find ways to even be better for the benefit of you and for the world. Thank you.
Well, thank you very much, Mark. Really appreciate those comments. What I would want to do is allow the panelists an opportunity to respond to the discussants, but I'm mindful of the clock, and I really would like to get to some questions before we go to our concluding comments. So if it's okay with you all, let's take some questions, and then as you respond, maybe you could respond to the discussants as well, if that works out. So we'll start here. Just wait until you have the microphone in front of you to pose your questions so that the large online audience can hear, and please offer your name and affiliation. So, yes, sir.
Can you hear me?
Yes. Go for it.
Michael Corbin, U.S. Department of Commerce, Senior International Trade Specialist. Thank you very much for this. It's very interesting. At the department, we're doing a lot of work with India and financial services, and that leads to my question of, in the book, do you deal with the role of that insurance and pensions could play in helping India's economy as well as its financial services markets grow? In particular, insurance companies and pension funds could help with the long-term capital problem. They would be great sources for buying long-term corporate bonds and so forth, and also investing in infrastructure and education, other sorts of things. So I'd interested, first of all, if it's in the larger publication, and any comments you may have on those two particular sectors and their role in India's financial sector growth. Thank you.
And thank you. And are there any other questions we could take together before we come back? And I may throw in one of my own. No? Okay. No? Okay. Oh, you do have one? Yeah, okay, yeah, so we have a question right down here in the front.
Tom Timber, consultant. Again, a very exciting book, which I now have to get the whole copy rather than the extract that's out here, and read Dr. Acharya's memo for Brookings. But I was interested in something that is in the things on the economy, also the World Bank World Development Report, which, though they don't say it, is essentially about India for 24. You didn't mention anything about remittances, which in static terms are roughly comparable to investment flows, and more generally the role of the diaspora, which has been so important for China, and the ambiguity of which we've just been reminded of by the Adani problems, which I think are being solved.
Thanks. And actually, the question I was going to add, you just hinted at, and a number of folks online posed the question as well about the Adani scandal, and if there's something to say about impacts that's had or has had or could have on the financial sector, obviously given just how omnipresent that corporation is across the financial sector. So who would like to respond?
Maybe I could start out with the part that we have not covered in the book, and you're right, there is a financial intermediation as it relates to insurance and pension funds, which is not the focus of the book. We do refer to it as part of the diversification of funding sources for the corporate bond market, broaden the investor base, but that's not the focus of it. And the point that you're making about remittances is also important. There are many other aspects that one could have covered, but that's not included in the book. And maybe just one issue on the fiscal side and privatization. India does have a lot of assets, commercially viable companies that could be transferred. The resources could be used for other purposes, so you privatize and use the resources, but
So thank you very much for all the comments and the insights from both Professor Acharya and Mr. Kennedy, and for the questions. Just to add that, of course, remittances and the role of the diaspora are very important for India. It's from an economic point of view, the flows of remittances are important and are a stable component of the BOP. So that contributes to external stability, having these inflows. On the issue of the conglomerates and whatever risks may be lurking in there, and try what the government can do to foster more competition. I agree with everything that Dr. Acharya said. I think one thing that may come out of the Adani story and the allegation is that there is now an ongoing investigation happening, led by there's one by the Supreme Court and one by the government, and hopefully we will see what these investigations will conclude. So we have to wait and see if there will be any directions for further reforms in the corporate sector that may facilitate greater competition. On the specific events of the allegations and the fallout for the Adani stocks, this has been really contained, and we don't see for now implications for the financial sector more broadly. The financial sector and financial markets have been more rattled by what's happening on the global scene in terms of shifts of expectations of monetary policy tightening and then loosening in advanced economies, and the failure of these some of the regional banks in the US and the Credit Suisse in Switzerland. So these events are driving more the flows than anything that has happened domestically. I'll stop there.
Anyone else want to respond before we? Okay. So unfortunately, we are going to need to wrap up now, but we did want to hear from the fourth and final co-editor of this book who's here with us today. Yes, and Dr. Anne-Marie Gold-Wolf is going to offer some closing comments. She's the Deputy Director in the IMF's Asia and Pacific Department. She directly oversees the department's work and policy priorities on South Asian countries, India, but also Bangladesh, Bhutan, Nepal, Maldives, and Sri Lanka, which means she must be quite busy. So please.
Thank you so much, and good afternoon to all. It's really a pleasure to have been here, and let me thank the Wilson Center for partnering with the IMF and allowing us to have this very spirited debate as we launch our publication. In closing, let me take a few moments to just reflect on what we have heard and what our key takeaways are. So India's economic progress has in fact been remarkable over the past few decades, notwithstanding some of the shocks that we have seen. Today, India's economy is a relatively bright spot in the world economy, and it has a significant potential for further growth underpinned by its positive demographics. This potential can be realized through greater investment in job-generating economic activities. And here, the financial system can help with the needed investment. The financial sector has contributed to the success as we have seen it. Banks, non-bank financial companies, and market-based financing have all helped to extend credit to the private sector. Various policy initiatives and reforms have helped strengthening financial stability and reduce vulnerability, both of which are solid foundations for sustainable economic growth. Furthermore, digitization of financial services has been instrumental in bringing more people into the financial system, improving financial inclusion, therefore, reducing poverty and therefore driving economic growth. It's been a remarkable achievement that has impressed the world. With continued well-coordinated financial and real sector reforms, India's financial sector can play an even greater role in driving economic growth and prosperity in the future. On the financial sector, the needed reforms include strengthening the non-bank financial sector through funding diversification and reducing the public footprint in the banking sector, and importantly, enhancing governance. Deepening the development of corporate bond and environmental, social, and governance, or ESG markets are also important. Finally, continuing to leverage digitization through promoting digital and financial literacy for all can foster further growth and inclusion. To reduce financial sector vulnerabilities and improve credit allocation, improving debt resolution frameworks, and continued institutional reforms that reduce market volatility are critical. So with all of that, we hope that the findings of the book and today's discussion will contribute to the authorities' thought process going forward. We also want to emphasize that we, of course, continue our debate with the authorities through our ongoing surveillance engagement. We also plan for next year an in-depth assessment of India's financial sector, which is called the Financial Sector Assessment Program, or FSAP for short, that really will give a chance to further deepen. And with the study that has already taken place, we can start out that debate at a hopefully much higher level. Let me thank you again and hand back to Dr. Kugelman. Thank you.
Well, thank you very much. And all I'll say before we adjourn is that this has been a terrific discussion. I certainly have learned a lot. This is an important discussion. Some of you may be familiar with the very noted India scholar Alyssa Ayers, and her recent book is called Our Time Has Come, and it essentially refers to the fact that India has an opportunity. We see how fast its economy is growing. It's ready to step up and to play a major role in the world. It already is. But that means that the number of questions, such as its financial sector and how it performs and how that can contribute to its broader growth story, the defining theme of this discussion, this is very important and very significant. So I really want to thank, again, the IMF for partnering with us. This has been a great discussion. I thank our 4 co-editors for being here with us, as well as our 2 discussants, Viral Acharya and Mark Kennedy. Thank you, the audience in person, and thank the audience online. I'm sorry that we couldn't get to all the questions. We do need to adjourn. For those of you that are here in person, your reward is that we will provide you with lunch. And once we adjourn, my colleagues outside will direct you into the room where we could continue the conversation informally. So if we could have a round of applause for the participants. We will now adjourn. Thank you all very much for coming and for tuning in.